Let's talk about the big picture takeaways from the day with Kathy Jones and Jeff Kleintop. Kathy's Chief Fixed Income Strategist and Jeff's Chief Global Investment Strategist. Great to see you guys. Pretty big day here today for the path for the Fed. Kathy, give me the latest on the timing. I haven't checked in since this morning, but it looks like we're not getting any cuts, at least till what, like the fall now, or where are we at?
Yeah, it looks like the market is pricing in the possibility of one cut late in the year, maybe December, which is almost tantamount to saying no rate cuts in the foreseeable future, or this year at least. So those CPI numbers really took the last hope away that we were going to see any rate cut from the Fed anytime soon.
What was so damning about the numbers this morning, Kathy, in your mind?
Well, you could make the argument that the January numbers tend to sometimes come in a little hot due to seasonal factors that aren't completely captured by the seasonal adjustment process. But these gains were pretty much broad-based, mostly in the service sector as usual, but the goods sector didn't provide any help this time around. Those were up as well. So when you look across the spectrum, prices were elevated in just about every category. And obviously, housing for CPI is a big component. That was up. Food prices were up. Energy prices were up. So it was hard to find a category that didn't post a pretty big increase. And then the momentum, if you look at the 3-month rate of change, 6-month rate of change, all of that has turned higher. So even if the next 6 months come in, flat or low, it's going to take some time to get that momentum to shift to the downside.
Okay. So that momentum shift to the downside looking like a far cry right now definitely changes the game a little bit here. But Jeff, relative to the rest of the world, I mean, we were planning basically for the U.S. to be kind of the most stringent handing out cuts, right? So how does this kind of play out in terms of the central bank divergences that were already there? Does this exacerbate it even more?
Perhaps. I mean, we're going to get some of the final January readings on inflation in Europe this week. The numbers are fine. They're really nothing to worry about. So, yeah, I think the trajectory of rate cuts are on track. Clearly, central banks are watching what happens with tariffs and potential inflationary consequences. But for the most part, what we're seeing is embedded in the differing trajectory seems to be there. I know you talked earlier about the impact on the dollar. I think what we're seeing there is just the tariffs coming out of the dollar. We've got Ford CEO announcing he's going to D.C. to talk to the administration about the quote unquote devastating impact of tariffs. Of course, he's talking about his company's exports from Mexico to the U.S. and aluminum and steel tariffs, all of that. So I think a little bit of this is backing out some of the prospects for tariffs in the U.S. Obviously, it's still earlier in that game. There's a lot of give and take, but I think that's some of what we're seeing in the markets today.
Yeah, that divergence, which has been some of that dollar strength, Kathy, seems like I was a little bit surprised that the dollar wasn't stronger. But I guess there's also the kind of tariff element too. What are your thoughts there on how rates should correlate with the dollar right now?
Yeah, well, typically they would be moving more closely together, but I think Jeff's right. A lot of the focus is on tariffs. Will we get them? Won't we get them? Will there be exceptions? How big will the exceptions be? Will there be carve-outs? Is this just negotiating and it'll all come back down? Nobody knows the answer to that, but the dollar has had a very big move up on the prospect of tariffs, and now it gets a boost from the interest rate differential scenario. But I think day to day, there's going to be some back and forth as the market tries to figure out where we are on tariffs.
How did you think about Powell's performance today, Kathy?
I think he's a very brave man to have to go in front of all those Congress people every day and listen to all those questions that are speeches. But I don't think there was any change in the message. It's too soon to think about rate cuts. They're in no hurry. The economy is strong. Inflation's elevated. I don't think anything new really came up. He didn't have any insight into ending QT anytime soon, or in any big regulatory changes coming up. So this was pretty much going through the motions for Powell today.
Jeff, we talked about how the EFI, the international index, has been outperforming U.S. so far this year. As we get more details on tariffs and move closer to some of those expected timelines, with inflation now here, maybe causing the Fed to be a little bit tougher, Should that benefit international stocks even more than they have been?
Perhaps. I mean, what we have not seen is a lot of that valuation gap begin to close. Remember, the historical valuation gap between EFI and the S&P 500 is about a 17% discount for EFI, largely due to sectoral differences. But we're looking at around a 40% discount now. And that gap should begin to close as growth rates begin to converge a little bit this year. But one of the drivers of that could be more rate cuts. Generally, an accommodative central bank does tend to coincide with rising price to earnings ratios, and there's room to do that in Europe and EFI overall. The PE is at or just below its longer term average, so there's room for that. That's a possibility here. We'll have to see. German stocks are up. The DAX is up 12% in dollars so far this year. So we're starting to see that some of that is earnings and economic momentum. Some of that is that valuation gap beginning to close, and I'd say perhaps some of that is tied to the differential in the trajectory on the rate outlook.
All right, great stuff. Appreciate it, guys. Thank you very much. Good context.